Hey everyone, this is Dale Anderson, the Managing Director at Fabric Property Group. So today I wanted to bring you the latest property market news for the last month of May. Today we'll dive into the topic of the interest rate crisis, new proposed government regulations and policies, and how this may impact your property investing in the UK. So buckle up and let's get started.
Now, we've been talking about commercial property, but is the residential market defying predictions of a slump? Online property site Rightmove said average asking prices jumped 1.8% in May, hitting a new record high. And official data shows house prices rose more than 4% year on year in March. But shares in UK house builders fell yesterday as Britain's inflation rate came in stronger than expected, fueling bets on more interest rate increases.
First things first, the Bank of England has recently made a significant move by raising the base rate to 4.5%. This marks the 12th consecutive interest rate hike, and it's causing quite a stir amongst those who fixed rate terms or in interest terms are expiring. So with 16 years of experience in the real estate industry, we've helped raise over £1 billion for buy-to-let investors, and I've witnessed firsthand the implications of market shifts, including the recession of 2008. Might be thinking that this isn't an ideal time to invest due to the prevailing doom and gloom. However, history has shown us that challenging times can often bring about great opportunities. So the key is to know what you're doing and employ the right investment strategy. After all, the UK has been one of the most resilient markets over the mid to long term, simply due to the imbalance of supply to meet demand. So let's go into the interest rate crisis.
Inflation remains too high, and it's our job to get it all the way down to the 2% target and have it stay there. And this is why today we've increased bank rate by 0.25 percentage points to 4.5%.
On May 11th, the England's Monetary Policy Committee decided to raise interest rates by 1/4 of a point, bringing them to their highest level seen since 2008. For years, buy-to-let landlords benefited from the low interest rates, generating substantial profits from single-let properties. However, with interest rates on the rise, landlords on variable mortgages are facing a tough situation. Many of them will now find themselves paying more in interest each month than they earn in rental income, which poses a significant challenge. So among landlords, there's a mixed variable and fixed rate mortgages. For those on fixed rate mortgages, the real issue arises when the fixed term comes to an end. Shockingly, statistics indicated that around 1.3 million households are currently on fixed rate mortgages that will mature in 2023. So imagine going from an interest rate as low as 1 or 2% to a tripled or even quadrupled rate of 5 or 6%, depending on the package that they offer you.
The latest data from the mortgage market shows that average 2- and 5-year fixed-rate mortgages are both now above 5%. They're approaching levels last seen in the autumn, at the time of the mini-budget. That means for the average household looking for a 2-year fixed-rate mortgage, repayments have gone up by more than £340 in the last 18 months. And they could go even higher.
This does pose a major problem for landlords and homeowners alike as they struggle to cover their mortgage payments amidst rising costs. So the decision to raise interest rates once again stems from the persistently high inflation rate in the UK surpassing 10%. While many anticipated a decrease in interest rates as inflation subsided, the Bank of England has projected that interest rates won't decline until at least 2024. The purpose of using interest rates as a macroeconomic tool is to make borrowing more expensive for businesses and thereby slowing down the economy and reducing spending. This in turn should help curb inflation. However, the current high inflation driven by soaring food and fuel prices has created a perfect storm, leaving the Bank of England with little choice but to further increase interest rates. As a result, more landlords with variable rates will find themselves unable to profit from their properties and probably opt to sell them. In fact, in recent months, there's been a surge in landlords selling their properties. This reduction in the property supply will subsequently drive up rents, which have already been increasing across the UK. Unfortunately, well-intentioned policies implemented by the government, along with changing legislation and increased regulations, have contributed to landlords feeling targeted and reconsidering their role in the marketplace. So while politicians and policymakers attempt to address issues in the property sector, their actions sometimes do have unintended consequences. Take, for example, the Article 4 direction implemented by local governments and councils to remove permitted development rights. This means that in certain areas, turning a regular house into an HMO or housing multiple occupation through permitted developments becomes restricted. This leads to a rush of investors trying to acquire properties before the Article 4 direction takes effect, inadvertently increasing the supply of HMOs instead of restricting it. So this highlights the disconnect between policymakers' intentions and the actual outcomes in the property market. So considering all these factors, it's clear that the repercussions of the interest rate increase will significantly, I anticipate that many of the 1.3 million households mentioned earlier will face financial difficulties, struggling to afford their mortgages. Consequently, we can expect an influx of properties hitting the market for sale. Now, when it comes to property prices, there has been a gradual cooling down in the past 6 months with a slight blip of price increases in April. However, moving forward into 2023 and possibly 2024, I predict further declines in property prices. While we may not experience a crash akin to the one in 2008, there are landlords and property owners who still harbor memories of that event. Their fear may prompt them to sell their properties at reduced prices, seeking to cash out before any potential price drops do occur. So considering the current market conditions, it's essential to adopt the right investment strategies. If you're looking to buy property, securing favorable interest rates on completed single-let properties might prove challenging. Instead, I recommend focusing on high cash generating strategies like serviced accommodation through platforms like Airbnb, house shares, or investing in new build properties in areas experiencing regeneration and a high rental demand as well as rental inflation. With these strategies, you can make a smaller deposit initially and wait for the market to stabilize and then the interest rates to decrease by the time the properties are completed, which could be around the end of 25 or 2026. Alternatively, if you do have cash available now, it might be one of the best times to strike a deal as we enter a more buyer-friendly market. Cash buyers can negotiate discounts from sellers and take advantage of the current market conditions. It's worth noting that the UK government is currently considering regulations for serviced accommodation sector as well. While this brings the potential for improved standards and guidelines, it also means additional requirements such as legislation, licensing, and safety regulations. Nevertheless, the demand for high-quality HMOs and serviced accommodation remains strong, especially among young tenants and students who seek community-orientated co-living space and co-working space with facilities. These tenants often prefer sharing rental costs in HMOs while enjoying the benefits of a well-maintained living environment. So when it comes to off-plan and new build properties, it's crucial to choose developments where market values still align with comparable properties. The recent inflation in building materials does pose a challenge, but small apartments near business districts and universities in major towns or cities continue to attract a high demand. So these properties offer communal spaces, community living, and on-site amenities. So one advantage of investing in off-plan properties is the ability to secure them with a deposit of as little as 10 to 20%, and you can defer the balance payments until completion. This allows time for the markets and interest rates to hopefully stabilize and come down, make it a potentially wise investment for those concerned about inflation or currency devaluation, especially for international investors seeking fully managed properties where they can hedge against the sterling for income. So it is still one of the strongest currencies in the world, and it is definitely one of the still the strongest property markets in the world in comparison to many other countries where people are looking to sort of get money out of the country. So at Fabric Property Group, we understand the complexities of these market conditions, and we can provide tailored advice and guidance based on your specific requirements and goals. As Warren Buffett famously said, be greedy when others are fearful and fearful when others are greedy. There are exciting opportunities to explore even in uncertain times, and we'd be happy to arrange a personalized consultation to assist you further and answer any questions that you may have. So thanks for your time today. I really hope you found this useful. Please click the subscribe and like button. Feel free to share it, and we look forward to helping you in the future with your property investments. All the best. Take care.